Since recording the video on Dave Ramsey and the withdrawal rates, remember the one where he said that stocks return 12%, inflation has averaged 4%, and therefore you can begin with an 8% withdrawal rate in retirement, adjust that for inflation, you'll be fine. And he was very, I think, dismissive of initial withdrawal rates in the 4 to 5% range. A lot of folks have emailed me and they said, Rob, I not that I disagree with you necessarily, but I don't really get it. If stocks over the long term have averaged 12% or even let's say 10%, why is it that we can only start with 4 or 5% if we want to be really safe with our approach or safer? It just doesn't make sense. Where does the rest of the returns go? And it's a good question. And the answer is what's called sequence of returns risk. And it simply means this, that it's not enough to say, here's been the long-term average. In fact, we can even just assume, we'll take Dave Ramsey's numbers, we'll assume that over the next 30 years, we're going to earn an average of 12%. So in other words, if we added up all of the returns year by year for the next 30 years and divided by 30, it would come out to 12. And we could do the same thing with inflation and it would come out to 4. Even if we knew that ahead of time, believe it or not, it wouldn't tell us what the safe withdrawal rate is. And the reason is because we don't know what order those returns are going to come in. We know they're not going to be 12% every year. Some years they'll be 20 or 25%. Some years they'll be negative. Same thing with inflation. It goes up and goes down. And in order to actually understand a safe withdrawal rate, we need to understand that order because it has a huge effect on how retirees end up with financially as they work their way through retirement. What I want to do in this video, at the risk of being called a math nerd, I want to show you some of the math behind this with a relatively simple spreadsheet. So here's what we're going to do. Here it is. And of course, I'll walk through all of this with you. But what I wanted to do is an initial point is we need to understand how a variation in returns from year to year affects the results. So what I'm assuming here is that we're going to put a lump sum of money in. I've got it at $1,000. We're not going to add anything to it. We're not going to take anything out. Very, very important assumption. And we're just going to see how it performs. And so I start with sort of the Dave Ramsey 12%. And just each year it earns 12%. Obviously, that's not realistic. You're not going to earn the same thing each and every year, certainly with stocks. But if you did, your $1,000 would turn into $1,405 bucks. So there you go. Pretty straightforward, right? Now, that raises a question. Okay, well, we know we're not going to earn the same return every year. So what if it still averaged out to 12, meaning we could add up the 3 years of returns, divide by 3, we still get 12, but it varied from year to year? Well, let's try that. We'll start with, we'll say in year 1 we earned 6%, year 2, 12, and year 3, 18, right? So that's still, add that up. That gets you to 36. Divided by 3 is 12. But you'll notice we end up with a few dollars less. We have $1,401. There's some rounding involved, but versus $1,405. Okay? And we've also got this number here that I've calculated for you. I'll come back to that in a minute. But the thing I want to point out is, yeah, we can add these returns up and divide by 3 and get the kind of mathematical average we all calculated in grade school. And yes, this equals 12, and of course this equals 12. But when it comes to returns on investments, that's not how it works. You actually use what's called a geometric mean, which is actually what this is, also called compound annual growth rate. When you have variability in the returns like we do, it actually reduces your return. Now, some of you may be saying, well, wait a minute, Rob, I get that kind of, but you started with the lowest number. Why don't we flip that? Well, okay, we'll come over here. We'll do 18 first. Then we'll do 12. Then we'll do 6. You'll see we still get the same 1401 number. And in fact, if we copy this compound annual growth rate formula, it's exactly the same. So there's sort of 2 takeaways. Let me bring this all into focus here. There's sort of 2 takeaways from this. The first is when you add variance to returns, it will reduce the ultimate result you get when we're investing a lump sum and we're not adding to it or taking away from it. We'll come back to that in a minute. And doesn't matter the order of returns. You can mix this up any way you want. We could put the 12 first, and then the 6, and then the 18. I can assure you, they're all going to come out to 1401. The order does not matter. And by the way, the more variance you have, the lower this 1401 becomes. So for example, we could say, and we'll put the highest number first, doesn't matter, 24%, right? And 12, and then 0%, right? That's still 24 and 12 is 36, divided by 3 is 12, right? We still get the same mathematical sort of grade school average, I'll call it. But look, our ending number has gone down, and of course our compound annual growth rate has gone down. You know, one way to understand compound annual growth rate is it's the rate of return you would need to earn each and every year to get this number. In fact, we can come over here. There's going to be some rounding, so it won't be exact probably, but we'll put in, see, I've already got rounding. Let me just show you. Here we go. And we'll put in, whoops, 1157 here. I didn't do this ahead of time, but I'm pretty sure it'll work. Yeah, and we get the same 1389. So that's really what the compound annual growth rate tells you. So for this variance in returns, it's a compound annual growth rate of 1157, meaning if you earned that 1157 each and every year rather than 12, 24, 12, and 0, you'd still end up with the same number. And you can see that over here. So lump sum investing, the order of returns doesn't matter, but the greater the variance in your returns, the lower you end up with in the end. All right. So now let's move to retirement. And to do that, I've got another set of numbers for you. We're going to make this a little bigger. There we go. So it's fairly straightforward. I just did 3 years, and let me walk you through this. Started with $1 million. I'm going to use the Dave Ramsey 8% withdrawal for year one, so that gets us 80,000, and that leaves us with 920. But over the course of the first year of retirement, we've got our familiar 12%. Good for us. We've now got $1,030,000 and change. Okay, end of the first year of retirement, we need to adjust our spending from last year by the rate of inflation. I'm going to assume 4%. So this was our spending last year. We're going to adjust it. You can see how I did it here. By the rate of inflation. That gets us our spending money for the next year, 8320. Subtract that from our balance, we're left with 947,200, and earn our 12%, and things are looking good. We're at $1,060,000. We do the same thing for year 3. Look at this. After just 3 years of retirement, we've had our spending money. We started with a big fat 8%. And we've got like, what, 9% more money than we started with on before factoring in inflation. We're doing great. Now, what happens now if we start to mix up these returns? We don't get an even 12% every year. Well, let's copy this. We'll move it over here so we can look at all this side by side. And we're going to start with our 8% spending money, right? Now, remember, when we were looking at the numbers up above, the order of returns didn't matter. Remember that, right? When you're either putting money into a portfolio because you're saving for retirement, or you're taking money out, and I realize I'm covering up some of the spreadsheets, so there we go, maybe that'll be a little better. Or if you're taking money out because you're in retirement, this is really important to understand, the order of returns now matters, and it matters big time. Okay, so let's first start with, in the case of withdrawals, you want higher returns early, right? So we'll go with 18% the first year. We'll stick with 12% the second, and we'll do 6% the third. And you'll notice as a result, we actually end up with more money. Yes, 18, 12, and 6 equals 36 divided by 3 is still 12, just like this. But we know that doesn't matter. But we've also got this, we're making withdrawals, right? And so order matters. And look, we end up with $1,098,000 versus $1,091,000. That's a pretty significant difference, particularly when we're only talking about just 3 years or 3 years of spending in this example. Now, let's look at order of returns. Let's copy this again, bring it over here. But this time, we're not going to earn 18% in year 1. We're going to earn 6. We'll still earn 12 in year 2, and we'll earn the 18% at the end. We have considerably less, $1,076,000 versus $1,098,000. Now, all things considered, we're still in pretty good shape, but of course we've had pretty significant and positive returns each year in this hypothetical. But the real takeaway is, look at our ending result, much, much lower than when we flipped the returns and started with good returns. And it's also a lot lower than when we just had 12% every year. There we had $1,091,000, but here only $1,076,000. And by the way, we can do the same kind of thinking with inflation, right? If we copy this yet again, let me move it over. There we go. Let me bring it back a little bit here. What if instead of 4% each year, let's do the first year over here, it was only 2%, but here it was 6, so we still average 4, right? We're at $1,078,000. But with this return, let's say we start with 6%, and then inflation is 2%. You can see it's a lot lower. Well, $4,000. It's notable, particularly only for just 3 years of returns. So what's the takeaway from all of this? Well, sequence of returns matters. Number one, it matters a lot. You get a good sequence of returns, meaning say in the first 10 years of a 30-year retirement, the market does really well, inflation is low. That can set you up for an extremely successful retirement from a financially speaking. On the other hand, if the first decade is not so good, a lot of bear markets, a lot of negative returns, and inflation is high, not only can that put a significant drain on your finances, it can actually, particularly if you're starting with a withdrawal rate as high as 8%, it can bankrupt you. You can run out of money. And in fact, historically, when we look at historical returns and historical inflation rates, with an 8% initial withdrawal rate, there are times when you run out of money in 10 years. And this is the kind of thing that I don't know if Dave understands it or not, but he certainly didn't talk about it in his video. And it's why we can't simply say, well, let's just use averages, and it's 10% or 12% for returns and some average for inflation. We actually have to look at the order in which these things happen. And you can do that one of two ways. You can look at history, and that's exactly what Bill Bengen did in 1994 paper. And there's a lot of tools that you can use to do that. One of the ones that I like is ficalc.app, which will do this for you and in fact show you each and every year, going back over 100 years, how each, in this case, 30-year retirement performed. And so that's a free tool that I would certainly recommend. I use it a lot for testing. So we can't just use averages. Sequence of returns matter a lot. Looking at history is one way to look at it. We could also run simulations with, say, a Monte Carlo simulation. One tool I use to do that is New Retirement. And what that does is it takes sort of average returns and average volatility, because remember that's so important, and then just runs hundreds or thousands of simulations of possible combinations of returns and inflation to give you an idea of out of all those simulations it runs, how many of them were successful, meaning you didn't run out of money based on your specific financial situation and the tools that can do that. But the sequence of returns is extremely important, particularly when it comes to retirement, and it's why we can't use averages. It's why we can't simply say stocks have averaged 12%. Most of the time they haven't, by the way, but fine. Stocks have averaged 12%. Inflation has averaged 4%. We'll just subtract them and start with an 8% withdrawal rate. That can get you into a lot of trouble. Now, I know I've been a bit of a math nerd, I guess, in this video. I'm kind of proud of it, frankly. But I think it's fairly straightforward. But if you have any questions, certainly leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.